Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions, how to take advantage of current volatility, and what strategies work, and some trading examples, and any questions you might have about your subscription. For those of you who are new, welcome. If this is your first live event, do me a favor, tap in first. Always want to welcome new subscribers. This is my brief bio. Was Executive Vice President, Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab. At some point, the company was worth over $2 billion. I'm very proud of that experience. Since I left Options Express, I worked as a consultant and investor in several financial technology firms here in Chicago. Started Tradespoon in 2012. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years. Mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science. Disclosures are very important. I'm going to go through live trading examples. So the trading stock and options involve risk, not suitable for everyone. You must be aware of the risks and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, should not be assumed that Faye first. Good morning from Denver. Love Denver. Great skiing. So welcome, Faye. Please consult your financial advisor prior to making any trading decisions. Also, should not be assumed that the future trade picks will be profitable or equal past performance. All right, before we get into a trading system, let's talk about current market conditions, what to expect. We had unemployment numbers, I don't know, I would say in line. Unemployment rate is down to 3.5, 3.6%, so very low. Participation rate increased slightly by 0.10, still probably lower before the pandemic started. And yields are high, right? Basically anticipating that the Fed will continue to raise interest rates in the next meeting, potentially raising above projected 25 basis points, potentially 50 basis points. And, you know, everywhere you turn on the news, it's a yield inversion, right? The 2-year yield is paying more than 10-year yield, 5 paying more than 10-year yield, signaling that at some point in the next, 12, 18 months, potential recession in the United States due to high inflation. Not the best timing indicator, but nonetheless showing that inflation is here and here to stay. So how do you trade? How do you trade this condition? This is again, I've been repeating this, but I do believe that historically, since 2008, the passive investment has outperformed active investment, right? Active investment. You see that a lot of hedge funds would open, close every year in the since 2008 pandemic. And if you just invest into the S&P and just hold it, you usually would outperform most active traders, right? Last year, S&P up 20%, before that up 20%. So, yeah, there were 20, but for the most part, if you just buy and hold, that strategy work. I think we are changing that environment where this is probably more of an active trade environment, where just buying and holding probably will not work in the next, I would say, 12 to 24 months, right? In the next year or two, you have to be an active trader. You have to, a lot of it is technical analysis, right? If before fundamental analysis was important, looking at the cash flow important, now you really don't know what the right evaluations of the company is at multiple 20, 30, 40, 10. Nobody knows what exactly the right multiple is. It changes on a daily basis. So I think technical trading is more important, technical analysis, looking at the microeconomic data, right? Your currencies, your treasuries, and how it influences the equity market. And just look at these support and resistance lines, right? So I drew some of these lines. This is the January downtrend we've been trading in January, February, March. Bulls are able to break, very strong rally. Every bear market has a strong rally, right? Fundamentally, the question is, and that's what you hear in the news. Is this rally? Is this rally in since the lows, since March lows? Is this the continuation of the bull market? Right, there are two choices. Every trader is trying to make one decision. Is this a continuation of the bull? Right. And everything will follow through. So is this a continue? If I know how to spell continuation. Of bull market, right? 2009, 2022, right? 13 years. That's choice number one. Choice number two is this, I don't know how to classify it. Violent, strong rally. Within bear market. We'll do this poll. We do have third choices. I don't know if it's possible. Some people say, Vlad, well, what about sideways? Well, sideways, what time? Maybe for next month or two, it will be sideways. But I'm talking about end of this year, middle of the next year, next 12 months. I can't imagine market can trade sideways in the next 12 months, right? We'll talk. This is all, 12 months, 12 to 18 months. Right? Where are we going? So sideways, I don't think is a choice. I can't imagine, even, basically saying that, Vlad, we can just trade between 410 and 480 for the next 18 months. Maybe for the next 2 months, 3-4 months, maybe, but not for the next 18 months, right? We either heading higher, one, right, or we heading lower, 2, 3 for So let's take that poll and just see what you guys think, right? And that's important, right? Whether you're a short-term trader, whether you're a long-term trader, whether you're a long-term investor, I think it matters, right? Even if, a lot of my friends, you have a full-time job and you're just managing 401k, it still matters. A lot of my friends basically say, well, I'll just keep my money in 401k. You can't really time the market. I don't look at it every day, but I would still argue, even 401k, you should rebalance once a quarter. You should rebalance once a quarter, and you should at least have an opinion, is this one or is this two? Because if it's one, yes, leave your money in 401k. If it's two, well, then maybe at least, right, don't go 100% cash, but at least consider raising cash, right? So I think it's important for any type of investor, whether you're a trend swing trader, momentum trader, any type of trader. So how many of you say one, and how many of you say two? Don, Crossville, Tennessee, love Tennessee. I do love Tennessee, a great state. Nashville, yes, great lakes and great hiking. Angelique, I'm good, how are you? Teresa, all right, so one. Continuation of the bull market, all right, one, Mark, one. Yeah, this is not the next 2-3 weeks, this is 12 to 18 months. Done, one. All right, mostly of you said one. Oh, very interesting, excellent. Most of you said one. I'm gonna go with two, right? So that some of my trade ideas will be, unpopular for now. So that's right. So that's the main case, right? So if you said one, right? If you said one, obviously in 401k you keep your money. Maybe think about that. Maybe there is a small chance that two can happen, right? So you should at least raise the cash, right? But the strategies should change. Strategies should change. So if I say two, right, then I'm gonna do my favorite strategies are debit spreads, right? Debit put spread. If you say two, then I encourage you to consider, debit put spreads, right? Or credit call spreads, right? Sorry, I'm wrong. No, one. Sorry, if you said one, debit. Oh no, if you said two, right? Debit, credit call spread, bearish strategy, right? This is because this is a bear. I think it's a bear market, so I would use debit put spread, credit call spreads. I would still use iron condors. Well, not if you say this is, well, yeah, iron condors, right? Iron condors. If you're bearish, right? Market neutral or just outright bearish spreads. But I would not go, 100% in cash, right? Or I would not just buy puts because you don't know, right? Because the market can continue going higher even within a bear market, right? So if you said two, right? So for minority of you who said one, two. For majority of you who said one, you kind of have to follow, your belief. I mean, you can say one, but then if you're doing bearish trades, that also doesn't make sense to me. But but this would be, debit call spreads. You would do debit call spreads, right? You would do credit put spreads, right? Bullish strategies. I would still consider iron condor, unless you think, well, iron condor is a question mark, right? Probably you don't want to do iron condor if there is a continuation of the bull market. So the strategies change, but I still encourage you. The reason I'm using the option spreads is because all these strategies that I just mentioned allows you to go long and short the market at the same time, right? Whether you said one or two, you can defend your trade, right, to hedge your position, right? So you are long and short at the same time, and we'll go through some of the examples. Like I said too, so I'm going to go over some of the trades that I did to hedge my portfolio, right? But this is the most important, that should influence your portfolio beta, right? Your portfolio beta. This decision should influence your portfolio beta, and it should influence your, number of positions and position size, right? Because if you set strong rally within the bear market, I encourage you to have less position and reduce your position size, more than you did in the past 14 years. If you say it's a continuation of the bull market, then you could probably have more positions, and position size should still be the same. So that's my take in the market, right? And the idea is that, right, both can be right? There's no such thing as 100% certainty that this is one or 100% certainty two. Something has to happen, right? For those of you who said one, well, the assumption is what makes sense. The only way one can happen if the inflation is temporary, right? Starting in April, in May, when we get the PPI number and CPI number, it has to start decreasing, right? The inflation has to start decreasing, right? Because if inflation doesn't decrease and Fed is going to continue raising interest rates, then even if at some point the companies will make less money, right? Their margins will go down because of the inflationary pressure. If wages and input costs will continue to go higher, and quarter over quarter, companies' margins will decrease and their revenue will decrease, right? So that's the assumption, right? That the inflation is here temporary, employment is very strong, and that has to continue, right? That's the assumption. The bear argument is that yield inversion has happened, inflation is here to stay, it's not transitory, right? The wage pressure is going to continue, and commodities and input cost is going to continue. By definition, we're trading in a classical end of the bull market. At some point, this bull market is going to end. The question is when, right? Is it, I think it's going to happen within the next 12 to 18 months. Those of you who said one, you think it's going to either never happen or happen after 18 months. So, so that's the idea, right? I encourage you, if you said continuation of the bull market, beta should be maybe 1, somewhere between 1 and 2, right? If you said 1. If you said 2, I would say beta should be somewhere between 0 and 1, right? How many hedges you have, and if you said strong rally within the bear market, then for every call, maybe, for every call, right? If you said 2, I would say for every call, you have 1 put, right? And if you said 1, then maybe for 2 calls, and I'm not talking about call, basically bullish position, right? So for 1 bullish position, you have 1 bearish or 2 bearish, right? If you think that the market is oversold, right? And if you're, and if you said 1, then it's for 2 calls, you have 1 put, right? That's how you would structure your portfolio based on what you said. And that's important because Tradespoon, we give you signals. We'll give you both bullish and bearish signals, but you have to decide how many contracts you have to do and what your portfolio composition, right? Or you have to get a financial advisor who's going to help you. But I'm not going to tell you. Everybody is different, right? You can't have a universal rule. But I encourage you to think in these terms. Based on what you said, 1 or 2, how many calls how many bullish positions you have, how many bearish positions, and what your portfolio draw down. Because ultimately, nobody knows whether the 1 or 2 is going to happen, right? I can say I believe in 2, and I'm going to structure my trade, this way. And if you said 1, then you will structure your trade this way. But nobody knows for sure what is going to happen, right? That's what trading is all about. You have an opinion about the market, and then you follow your opinion on the market. And the goal is, whether you said 2 and 1 happens, or whether you said 1 or 2 happens, right? The goal is, I propose, is follow these 2 rules. Rule A that you never break is that you have at least on average 30% of your portfolio in cash, right? Right, trading, you have to put your ego outside the door, right? It's not about right or wrong. It's about opinion and how much money you're willing to invest based on your opinion. And your opinion will never be always accurate, right? Sometimes you'll say 1 and 2 happens. Sometimes you say 2 and 1 happens. So how do you deal with uncertainty in the market? Well, the way you deal with uncertainty in the market, you basically say, well, no matter what happens, I'm going to keep on average 30% of my portfolio in cash. If you said 2, maybe it's 45% cash. If you said 1, maybe it's 10 to 20% cash. But whether you said 1 or 2, this number will have to adjust, right? You can't say 1 and I'm 100% in cash. Well, then this is just an academic exercise, and it's not going to help you manage your money, right? But this number is dependent on what you said, 1 or 2. And the second rule, the rule number 2 that you should not break, only have 4 positions on average times 2.5%, and the maximum loss is 200% of account value, right? You don't risk more than 2.5% of account value. This way, 10% drawdown, right? If you said 2 and 1 happens, then you're not down more than 10%. If you said 1 and 2 happens, same thing, right? You want to protect you want to know what your volatility in your own portfolio will be, right? More important than knowing whether 1 or 2 happened, not before that, you have to follow rules that you don't break. My rule is cash, on average 30% in cash. If you said 2, I would say maybe 40 to 50% in cash. If you said 1, maybe 20 to 30% cash. And then rule B, if you said strong rally within the bear market, that means that everything is highly correlated to each other. There's no reason to have 8 positions, because you're basically chasing the same trends with just different positions. You over concentrated in one, right? You're buying oil, you're buying gold, you're buying, Caterpillar, but they're all highly correlated to each other. So 4 positions, pick the 4 positions, what you will trade. It could be oil, it could be industrials, it could be financials, it could be technology, right? Or it could be Bitcoin, consumer staples, euros, and something else, right? So you pick your 4 positions that you will trade around, and maximum loss is 2.5%. Because one thing that I want to make sure that if I set 2, right, and all of a sudden in April the CPI and PPI data improves, or in May CPI PPI data improves, and market starts continue to go on higher, I don't want to be down more than 10%. That's one thing that I know that I would be very disappointed, right? So this idea of fear of missing out. What does fear of missing out meaning to me? That I would be upset, right, if I said it's a bear, I think it's kind of a bull trap, right? Bear, strong rally within the bear market. But if I'm, if I end up on the wrong side of the trade, I will have fear of missing out. So I want to make sure that my account value doesn't drop, more than 10%. Ideally, less than 10%, because I still have bullish positions. And vice versa. If I said, if you said 1, right? If you said 1, basically you're assuming by the end of the year we will be above 4,800. But if by the end of the year we're going to be, somewhere at 3,600, right? 3,600. Same thing. You don't want to be at the end of the year. Your portfolio should not be down more than 10%, right? Because you know that if your portfolio down more than 10%, you have this fear of future regret, right? Fear of future regret. That if I only reduce my size, and if I'm only, instead of 4, had 6 position, right? So those are the 2 fears that pull all the investors in different opposite sides, right? Every day, either fear of missing out pushes you, right? Because market has been up for 11 days. You feel like you missed the train. So you have to pile into the trend, right? And vice versa. When the market is down for 20 days, you feel like market, it's the end of the world, and you have this fear, of future regret. So very important concepts, something to think about it. I encourage you to think about it. So trading plan, review the cash, review portfolio drawdown, watch the live trading room recordings, right? We do have live trading recordings available to everybody. Where are they? Event recordings, right? Review the strategy roundtable. That's what you want, and review the trading room. This is available to you, and you watch it a few times, right? And that will help you understand the psychology behind my trading and Scott's trading. Scott is another trading coach that we have, and we believe in compounding investment, right? So psychology of money, right? A lot of people ask me, Vlad, how do I find the next, how do I know when AMC is going to go up 40%? It's probably a wrong, form or wrong subscription, right? I don't have, tools to detect 40% increase in a stock, in the next 2 days, right? So that's probably not going to happen. Nor do I know which stocks is going to be 40% up by the end of the year, right? So we're not picking stocks that are going to quadruple or 10 times increase, right? We are in business of finding trends, right? Finding trends, finding support and resistance levels, and compounding investment, right? That you can have 40, 100, 200% return a year if you trade in options, if you properly position your position size. And it's all about compounding investment. What does it mean to me? Again, it depends on how frequently you trade in and what your position size, right? The goal is 3 out of 4 trades to be successful, right? So that means 75% accuracy, right? So 75% accuracy, you know, even if you look for, let's say, 0.5% return, right? You can look for 0.5% return on the trade. You know, you multiply this by 3, right? You subtract one trade, let's say 1% stop loss on one of the trade, right? So then 1.5 minus 1, basically your return is 0.5%, right? 0.5% return. It seems very little, and maybe not worth the time, but then compounding investing matters, right? How many trades do you do a week, and how many contracts or how many shares, right? So even if you do, you know, even if you return 0.5% a week, right? You multiply this by 4 times, right? 4 weeks in a month, you get 2%, right? You can get 2% in 1 month, right? In 4, you know, in 12 months, you multiply it by 2%, you get, you know, 24%, right? And this year, probably market will not be up 24%. You know, I would be surprised even if it's flat. So, you know, if you can get 24%, that would be great. And that's the power of compound investing, right? You don't have to look for 10 times, 20 times the return on your investment. You can look for 0.5% return on your investment, right, on your trade. And, you know, as long as you're doing this, you know, taking advantage of the volatility, trading out of the money options, it adds up, right? And if you want 48% return, well, you know, you just, instead of 1 contract, do 2 contracts. You know, if you want more, then instead of 2 contracts, you do 3 contracts. Number of contracts will, you know, can exponentially increase your returns. The problem is doing more contracts, you're taking more risk. And on a smaller portfolio, you know, if you're trading during market sell-off and all of your, if you set 1 and the market pulls back 10%, you can quickly lose, you know, more than 10% of your portfolio. That's why I encourage you for now just to do 1 contract. If you're new to trading, you should never do more than 1 contract, right? It doesn't matter what the stock price is. Certain strikes, you know, certain stocks that are 400,000, you shouldn't even do with option contract. Stock trading is the same thing. You would use dollar cost average, right? You would use dollar cost average, and every time you trade, you have to determine the position size, right? Position size. So let's go through some of the examples. Let me see if you guys have any questions. Kevin 3, love it. All right. Chat, Angelique, Trader Ken, thank you for answering. All right, so let's look at some of the examples. How to determine the size. So FCX. Okay, so today I closed FCX. Let's see, do I still have FCX position? No, I closed FCX. So here's the example of FCX and how do you determine that position size, right? So I bought FCX in the beginning of the week, right? 49.05, right? So I bought at 49.05, then I bought it at 48.25. So I bought it at 49. So let's look at FCX. So it dropped to $49, I'm buying. So now the next question is how long, you know, am I a day trader? Am I a swing trader? If you're an active trader, right, and you're not a long-term investor, the most difficult question, and that will take probably months for you to kind of, for me it took years, for some people it takes months. Well, how long am I going to hold this position, right? Usually the answer, like if I ask you guys now, how long do you guys usually hold the position? And do you know how long you will hold the position? What's the average? And it doesn't have to be exact, you know, you can say 1 to 2 days, 1 to 2 months, you know, 1 to 2 minutes, you know, 1 to 2 years. But, you know, when you enter the trade, do you know how long you will hold the position? Or at least do you know where you're going to get in and where you're going to get out of the trade, right? Do you determine target gain and stop loss before you enter the position? All right, so Joseph, yes, done. 1 to 2 days. How many you say, I have no idea how long I'm going to hold the position? All right, so would hold position till the turnaround is good. Out by Friday. 1 to 2 depends on, much depends on a trade. All right. So I encourage you, the way I determine how long I'm holding position, I look at support and resistance levels, right? So if I'm, if I'm doing weekly or monthly trade, I look, you can look at previous week low, right? If I got into FCX, right, at 48, I can look at the support, right? Before that, support is, well, maybe here, right? This is one level of support, this is another level of support. So if it's a shorter term trading, I basically can say, you know what, if it drops below 48, I'm out, right? Because you can see this is a support level. If I'm more conservative, I can say, well, on March 14th, it dropped to 43, then this is a level of support, right? So basically, I have to determine where am I going to get out of this trade. This level of support is relatively short term, only 4 days. It probably will not hold, right? Or there is a good chance that it will not. This level of support, if it goes back to 44, it's a very strong support, right? It was the high for the entire month of February. It is the low for the entire month of March. You know that this is a good buy, right? So if you buy an FCX at 48, 49, you definitely want to buy it again at 43, right? If you have a strong conviction that, in the past couple months, this is where you want to buy. So I'm doing more conservatively. I basically say if I buy 49, it drops to 41, I want to buy more. So that's minus $8, right? So it can drop $8. Average account is $10,000. My goal is not to lose more than 2.5%. So that's $250. So $250, then I can buy, 30 shares. 30 times 8 is 240. So I can do 30 shares. I can use dollar cost average and maybe buy 15 shares here and 15 shares here. But I'm trading 30 shares because I know that if it drops below 41, I'm going to get out of this trade. And at that point, I don't want to be down more than $250. If you're more aggressive trader, you think that, this level support holds, right? This is around 48, right? Then, it's a dollar drop, right? It's a $1 drop. That means, you can buy more shares, right? $250, then maybe you can buy either 250 shares, right? 250 shares, or you can do 2 contracts if you trade in stocks. And I would still divide it into 2, right? Do dollar cost average. Do 1 contract here, 1 contract here, right? That would have been a good trade if you buy 1 contract here, 1 contract here, or you are split the shares into 125. So this thought process to me is the most important, right? And one thing that I learned from trading, always give myself more time. Don't try to time it, right? A lot of you said, I hold the position for 1 or 2 days. In this market, holding position for 1 or 2 days, you are bombarded with news. Every day, escalation, de-escalation in war in Ukraine. Every day, there's some kind of news. Market goes up and down, up and down. You can sell out of the money options premium, maybe, but if you're a trend trader, right? If you're just collecting the premium, great. You can trade and hold position for a couple of days. But if you're a trend trader, trend changes every single day, right? So you just have to be careful. So what I usually do, I give myself more time. How do you do this? You either, the way you increase the time is you do dollar cost average, you decrease your position size, and you move your stop loss levels to somewhere where you know that they will probably hold, right? Nobody knows whether the 48 will hold, but 41 probably is here to stay for the next, few weeks or even few months, right? So this would be a great opportunity to buy. 48 was a good opportunity, but So you give yourself more time, right? So that means that if you trade in weekly options, consider maybe trading monthly options, right? If you trade in April, consider May, or if you trade in May, consider June, July. But give yourself more time, right? And give yourself more space. What does more space mean? If you think that 48 is low, do calculations. Give yourself a little bit more time. Maybe 46 is your stop levels. But that means your position size has to decrease, right? The higher the magnitude of, the bigger the stop loss, not to violate 2.5% account value, you have to decrease the position size. So these calculations are the most important calculations. This is something you have to decide for yourself. A lot of it depends on psychology. A lot of people get frustrated with those daily moves up and down in the market without trying to predict them, right? It's very hard. But if you look at if you look at longer term, if you don't have 1-2 days, very hard to determine. But you expand, you look at weeks or months, will definitely downtrend from January all the way to March, and now definite uptrend. Where we continue to trade higher, and we're in uptrend. So in uptrend, you execute your bullish position, but you want to give yourself more room, right? If you think that this is the low, 450. Maybe it's not. Maybe it's it's more conservative to think that 440, because here you have a strong support, right? You have this double bottom, right? You have this double bottom with the strong neckline, right? About 62% retracement. So you know that this would be probably a better buy than buying it here or having a stop loss here. Maybe this should be your stop loss. All right, so give yourself more time, give yourself more room, but look at these support and resistance levels. Any questions? Kevin, thank you. Yes, there's definitely bottlenecks and supply chain issues. Bulls have good argument, bears have good argument. At this point, I think bears have a better argument, but it can change, right? It can always change. But for now, I think bear argument to me is more appealing. All right, so how do you trade in these? What do we offer at Tradespoon? So if you want to follow my trades kind of real time, then we have different portfolios. We have premium portfolio, robo-investor portfolio, and elite. What is the difference? A robo-investor only stocks 4 trades a month. Premium portfolio, I only trade option spreads. Same thing, 4 trades a month. Elite circle, it's a combination of short-term and long-term trading, right? And I do some of the earnings strategies. I do some of the stock strategies, different examples of different strategies. And you can see that there are a lot of trades, right? If you look at the last 7 days, almost on every day there is some trade. I put an order to buy Microsoft. I close LA Lilly, I close Micron, I close QQQ trade. So every day you will see the trades. The good news, you get SMS messages and you can see my trades live, right? Some people ask me, like, when do you think is the trend changes? Well, you can kind of see when I do these trades, right? If I put down, this example of QQQ, I would just watch my QQQ trades. I think the market is overbought, so I sold 390 call, bought 410 call. So short term, I think, again, risk versus reward, right? I did QQQ 390 call, basically saying that, I would be a seller at 390 when it was here. What does it mean? That, there is a best case scenario, we have 20 points to the upside, right? In the next, let's call it May 16, right? That's scenario number 1, right? Scenario number 2 is we retrace back to 350, right? Minus 20 points. And I did credit call spread, right? So I think that event number 2 is going to happen first, prior to May 16, right? And same question to you guys. Do you think that event 1 is going to happen first? Or do you think event 2 is going to happen by May 16? Right now, instead of going into the next 18 months, what's going to happen by May 16? 1 or 2? Dan, could it be a bull flag on the spiders? It could. All right, the one very bullish. It's good. Anyone else? Joseph, 2. All right. Anyone else? So 1 or 2? All right, 1. Perfect. Anyone else? 1. Okay, so more ones. Makes sense. If majority of you said that in the next 18 months, this is a continuation of the bull market, the only way it can happen, that 1 is going to happen first by May 16, right? Because if by May 16, 2 is going to happen first, even if 1 is going to happen afterwards, let's say in June, you know that this is still, we're not making new highs if we're not making new highs by May, we're not going to make new highs, by end of the year, right? Market has to be able to reverse this long-term downtrend, before the end of May. If it doesn't, if we close, even here by end of May, my core scenario is that something like this is going to happen, right? And we're going to top out here, right? And then starting June, market is going to reverse, where we're going to retest this level and eventually break this level either summer or October, right? That has to happen for me to be right that in the next 18 months, that this is a bear rally, this is a bullish rally inside of the bear market, then this pattern has to happen. And I'll see it. If by May we're here, then most likely something happened, right? And we're not going to retest this level, right? This level is here to stay for a long time. All right, so by the end of May, I will know. By May, if we're here by end of May, then this is probably going to stay till the end of the year, right? If we are below this level, if we are somewhere, here or here, doesn't matter where it is, then most likely a retest of the lows, in the next few months. All right, any other questions? All right. So this is my core scenario, right? This is my core scenario. I think we have a pullback, right? We have 3 days of down lower lows. Most likely, there's not much support till 350, but I still think this is a strong rally. We're approaching earnings season. All the bad news are kind of factored in. Only positive surprise, and I think market can reach these levels, right? So I think market can reach this level, but I still think it's 2 first and then 1. 20 points to the downside, then 40 points to the upside. Worst case scenario, we retrace further, right? That would be 38, probably 38% retracement, right? This is 62. 38 would be the worst case scenario. Right? I don't think we're going to revisit these levels, but in Q1, in the first half of the year, right? So I'm in agreement with majority of the analysts that in the first 6 months, we're not going to revisit this level by, before end of May. Where disagreement is, I think we will revisit this level in second half of the year, where a majority of people don't think we're going to revisit this level in the second half of the year. That's the disagreement, I think. But 1 month off, you can't really time it, but it is important how you trade if you think we will revisit this level in second half versus if you're not, right? A lot of decisions in terms of portfolio construction and portfolio rebalancing will have to be impacted by that. Okay, so that's worst case scenario, and obviously the best case scenario that something like this. We have Friday, and then next week we rebound. Right, that's would be my best case scenario. My core is this, and that's how you should always think, because when you think about 3 different scenarios, core, best, worst, that will help you to avoid putting with the position size. Because if you think about absolute terms, right, for a very long time, I always thought about absolute level. I was so confident in myself predicting the market that I would say, well, it cannot go below 350. What does it mean? If you catch your thoughts that it cannot go below 350, your position size increases, right? And that's the biggest mistake you can make. If you think about best case, core and worst, obviously then your position size decreases, and when the worst case does scenario happen, then you buy more aggressively, right? Because if you don't think that the worst case is going to happen, right? In theory, if I'm bullish, if I'm bearish short term and I'm bullish, if I'm bearish, let's say in the next 2 weeks, then in the next 4 weeks, I believe we will revisit this level. In theory, I should be buying maybe a little bit here, 30% I should buy here for the best case scenario. Then for my core scenario, I should, maybe put 30% here because that's my, best case scenario, which is low probability. Then my core scenario is a high probability. Maybe I should put, 40% here or 45% here, right, in my core scenario. But then I should leave room for the worst case scenario, like negative surprise, right? Getting hit, the blind side. There's always, we all have our blind side, right? So 35%. Or 25, sorry, 25%. Because if you think about absolute terms, then what usually happens when it reaches your core scenario, you start worrying, but you're still optimistic, and then the worst case scenario happens, you capitulate, right? You capitulate and exit the trade because you're following your 2.5% rule and you exit out. So you want to avoid situation when the worst case scenario is happening, you're still in the, you get out of the trade. And the only way to do it is to think about best case scenario, core scenario, and worst case scenario, right? So that's a trick that I learned that helps me kind of make better decisions and avoid, the worst feeling is when you think this is where your stop level is, and if it goes a little bit worse, not a little, but in this case it could be 1 or 2% worse, you exit your position only to see strong rallies, right? Something like this. When it drops from here to here or here, right? This was a perfect example where I thought this level would hold, right? Because this was October, September low. If you think this is the low and you're buying aggressively and you're not leaving your room that the next low could be lower, right? And then most people capitulated here, right? Only to see, 10-15% rally from the lows. So that's the only way to avoid this, because you never know where the lows is. Is it lower? Is it higher? You never know, and you cannot. So the only way to do this is position sizing, using this dollar cost average or laddering to avoid the situation, right? How many of you know what I'm talking about? How many of you had a situation where you thought this is the low, you bought aggressively, and when the market dropped below these lows, you capitulated, right? You sold all your positions only to see a strong rally. How many of you experienced that feeling? All right. Everybody, right? No exceptions, including myself, right? Including myself. So we all did this. We're all doing this. The trick that I've learned is this fear of future regret. Like, I know this is my strongest fear is fear of future regret. I'm always afraid that if I put my position size here too big, and then we have, 340, 25, I don't know, 6% of additional drop, that I will capitulate only to see a strong rally. The only mechanism that I learned, that I found out that can, avoid this is hedging, right? You want to have hedges and position sizes. Hedges can help you, right? Overall hedges, right? Even if you're really bullish here, still consider doing a hedge. Don't sell naked put, do a credit put spread. Buy out of the money put just as a hedge, but something along those lines. And then, position size. If you're doing always 2 contracts, consider doing 1 contract, for that specific reason. All right. Bill Madison, next 10 days, what size drop are you predicting before up to 380? Bill, I predict this, my core scenario, right? Hard to predict the drop, right? But my core scenario is this. So we're at 362, 350, 12 points, 3-4% from this point, I think is reasonable to assume. we'll have 3 to 4%. Model is bullish, I agree, but you can see that there's a lot of deterioration in momentum, right? We had 4 days, we're not making new higher highs. And it's going to take some churning, right? Some basing process to break February low, right? It's a February low, it's also December low, right? It's November low. This is a very strong overhead resistance for technology, right? My opinion, the only way to break it is through earnings season. And Apple, Amazon's, they're going to start announcing earnings here, right? So that's where you're probably going to have a rally over the end of the April in QQQs. But before that, there's nothing positive that can cause this to break through. So sideways, sideways market down to 350 and then higher highs. Kevin, thank you. Thoughts on Costco? I mean, I love Costco, right? This is the bear market, the bear argument. Costco has a vertical move up, continues to make higher. Dollar Tree was on the news. On the model continues to go higher. What does it mean? People are afraid of recession. Which stocks do well in recession? Same thing that during pandemic is these, Dollar Tree, Walmart, Costco's of the world, right? They're going vertically higher. So my opinion is they're overbought. I would be a buyer into pullbacks. This is a classical end of bull market stocks, right? Just like XLU. I mean, these vertical moves to the upside, they're not sustainable. But it's a classical top building process. Classical top building process. I would be a buyer in pullback. I would not be chasing these stocks. All right, any other questions? All right, so that's Elite Circle. You can see all of my positions, orders, real time, right? We have morning session, closing session, everything gets recorded. If you're busy, you have part-time, full-time job, you get SMS messages. Same thing with premium portfolio. You get video, you get SMS message every time I trade. Here's an example. I'm going buying Apple, long-term trade going into June. Again, I'm doing spread. In ideal world, I want Apple to pull back so I can close 165 call and then let 160 call continue to rally, because I think short term we will pull back, long term we're going higher, right? So in the ideal world, Apple pulls back, right? Continues to pull back to 167, maybe 164. I close the leg, and until the end of May, middle of June, let my long call continue to rally. But I'm long and short Apple at the same time, right? I'm not trying to time the market, but I'm trying to determine the magnitude, trying to determine the trend, basically. Short-term trend and long-term trend. And spreads allow you to do that. That's the advantage of the spread. If you only trade in stock, then you can do the same thing. You can buy Apple at this level, right? Because you don't know, maybe maybe Angelique is right, and we'll just do this. It is one scenario. Or maybe, this is core scenario, right? That's a 2 scenario number 2, or maybe a little bit further, right? Scenario number 3. But whether you said 1, 2, and 3, I mean, you want to buy here, you want to buy here, and ideally you want to buy here, right? If you're bullish on Apple, you don't want to be, you bought Apple here, but on 50-day moving average, you sell off. Or if it drops below 50-day moving average, in theory, you also want to be buyer. But the only way you can buy, if you don't break the rule, right? A lot of people say, don't buy on the pullback, right? This is a problem, right? If position goes against you, cut your losses and leave. And they're absolutely right. If position goes against you, cut your losses. The only way position goes against you, if you are down more than 2.5%. You're down 2.5%, your position go against you, you should close your position. Doesn't matter if you think Apple is going to be here or here, it's irrelevant. You're on the wrong side of the trade, you're down 2.5%, you do not want to be down 5%. But if you thought it's going to be here, if you thought 50-day moving average will hold, but it dropped here and you only down 1.5%, and you still have a conviction that this is just overshooting, on some, headline news, then you can still be in the trade. So that is the very, position size is everything in trading. If you get it right, then you'll be correct more often than not. If you get position size wrong, then you'll be wrong more often than not, especially in this volatile, trading environment. All right. Any other questions? Done. Thank you very much. Have a great weekend. Thank you, Kevin. Yes, all the oil, and this is a perfect example, yesterday news, US is gonna, release their oil reserves, biggest ever in history. Like nobody can predict that event, and obviously that's gonna cause oil to drop, 5-10%. Tomorrow there'll be news that Russia is gonna turn off the gas from Germany, and oil is gonna spike up. That is what I'm talking about, because when the market is volatile, these headline news will move market one way or the other. But if you look at just technical analysis, you basically can say, well, you know what, this looks to me like a top building process, right? Uptrend, triangle, at some point it's gonna, maybe do this, but it's heading here, and it looks like it's losing momentum, right? Something has to happen in the market for it to break. I don't know what that is, maybe escalation of the war, maybe, maybe Russia turns off gas. Something drastic has to happen for oil to break out. Since you can't predict this event, you have to assume that this is a top building process, and here is where you probably want to buy, and here is probably where you want to sell, right? Without analyzing daily events, because they're going to happen, and you're going to have these headline news, all the time. Yep, Angelique, Marvin. Good morning, Marvin. Angelique, thank you. All right, guys, that's all I have for today. Thank you very much. Have a great day. And just remember, if one thing you want to get out of this presentation, hopefully, is, well, two things. One is the position size, and one is the compounding investment. This is not the market where you want to find stocks that will go up 10 times, this, what do you call it, 5 baggers, 10 baggers. That trading is on pause, right? Finding a stock that's gonna, penny stock that's gonna, quadruple 10 times, it's gonna be more element of luck for the next 12 to 18 months. So try to embrace the concept of compounding investing, and there's really no limit in compounding investment. You can make a lot of money, but you have to be very disciplined, you have to be very mechanical, and you have to be very confident. And it has to be a process, right? Process is more important than the outcome in this type of trading. Thank you very much, and I will talk. Well, some of you I'll see at the closing bell, and some of you I'll see you next week. Thank you very much. Have a great time.